So a 35%, wait, let me just make sure I'm reading this right. A 35% sequential jump, not year over year, but sequential growth. That is their data center projection for next quarter. I'm just laughing. That is honestly wild. It is May 26, 2026, and welcome to Earnings Unscripted. Today, we are digging into the first quarter for Semtech, ticker SMTC. And Miro, it really feels like this optical chip maker just strapped itself to an AI rocket.
Yeah, a four-way guide like that is definitely doing a lot of heavy lifting, but the actual first quarter results basically backed it up. Net sales came in at $291 million, which is up from $274.4 last quarter. Adjusted EPS hit 51 cents, up from 44. And the market just completely lost its mind.
Oh, I saw that. The tape was chaotic.
Absolutely. Regular trading closed around $109, but right near the start of the call and after hours, the price just violently spiked, hit an extended high of around $188 before cooling off into the mid-170s. Just massive reaction.
Jeez, a complete vertical line. And just to toss this in right now, clearly everything we say is just our personal opinion, definitely not financial advice. Please do your own homework. But honestly, even with all that hyperscaler excitement, the piece that I actually loved the most was actually on the IoT side, the LoRa networks.
Right, the new public safety use case.
Exactly. Usually we think of these low-powered chips doing basic things, right? Like checking agricultural sensors or reading water meters. But they upgraded the throughput, and now these public safety notes can transmit high-fidelity audio and actual live video verification directly to triage stations before first responders are even dispatched. So it is moving from basic logistics to literal life-or-death monitoring.
Which is an amazing technical leap, sure, although strictly financially speaking, the real life-or-death move for the IoT segment is what they're chopping off. The CEO finally confirmed that the sale of the cellular module business is in its final stages.
Oh, finally. Because that piece was just perpetually diluting them. It distracted from the whole data center thesis.
Exactly the issue. Offloading that simplifies the entire portfolio. And frankly, they need the structural margin boost. Overall, adjusted operating margin was actually quite strong at 20.4%, up over 200 basis points sequentially. But there is a serious catch. If you look at their absolutely most critical AI segment, the gross margins there actually dropped quite aggressively.
All right, let's get into the details on that.
So signal integrity is arguably their most important AI segment, but the gross margin there dropped from 67.4% in the fourth quarter all the way down to 62.7%.
Which makes zero sense on the surface. Demand is off the charts across the board.
Right, but the CFO, Mark Lin, was actually pretty transparent about the math here. The margin hit is almost entirely driven by integration costs from the Hyfo acquisition. They are spinning up that new indium phosphide manufacturing facility, and running a brand new fab in ramp mode is just massive. I mean, it is guaranteed gross margin friction until you hit scale.
Okay, I actually want to talk about that Hyfo deal because I think people see a margin hit and immediately panic, but they frankly had to make that acquisition. It was not really optional.
Go on. I know you looked at the background there.
Well, Hung Hu told this really fascinating story on the call. Before deciding on their whole R&D roadmap, he went on what he called customer sensing trips. He physically visited, I think, 10 different top module manufacturers just to ask what they actually need. And he realized pretty quickly that Semtech's core standard fiber edge products, they just will not work for co-packaged optics.
Because co-packaged optics, CPO, integrates the optical components directly onto the switch silicon substrate. It eliminates the whole electrical routing distance. So standard pluggables become obsolete in that specific setup. I actually have the CEO's exact quote on this. He said, "Our fiber edge product is not an opportunity because the customers will be using integrated solutions."
Exactly. So they realized they were staring down a huge structural gap in their product line.
It is a classic existential hedge. They bought Hyfo specifically to get their hands on DFB lasers and gain chips. If they did not do that, they eventually just get completely boxed out of next-generation hyperscale architecture.
Which is just such a brutal reality of the semiconductor market. You either buy your way into the next architectural shift or you die. But to your point, that survival mechanism is expensive.
Extremely expensive. Beyond the gross margin drag, look at the cash flows. Operating cash flow dropped 41% sequentially, down to $36.2 million. Now, some of that is a $29 million cash outlay for the acquisition itself, plus some annual bonuses in Q1, but capital expenditures also quadrupled this quarter.
Because of the clean rooms, right? For the gallium nitride chips?
Yes, the GaN capacity constraints. Demand for these specific chips outstrips their current supply by roughly 3 to 1 right now. Husi literally called this a time where capacity is king.
And that is inherently a good problem to have, having 3 times more demand than you can physically supply. But they are now desperately trying to build out 3 to 4 times more fabrication capacity by the end of the year just to catch up.
Which, let us be real, executing a 300% capacity expansion inside of 9 months in semiconductor manufacturing is basically running the engine at redline. If they stumble on that execution, they are leaving tens of millions in hyperscaler revenue on the table.
Not to mention they are bleeding equity to keep people around to actually do the building. Share-based compensation shot up 60% this quarter, from $16.5 million to over $26 million.
Exactly. You are paying a massive premium in talent and upfront capital just to stay in the race. It is growth, yes, but it is highly stressed growth.
It really is just this intense high-stakes arms race. So I guess the question is, where does this actually leave them heading into next quarter when investor expectations are literally sky high?
Well, they are leaning directly into them. The guidance for Q2 is frankly staggering. They are looking at roughly $328 million in total net sales. But the whole thesis rests on that 35% sequential jump in data center revenue.
Which is just, that is exactly what you want to see if you're an investor, watching them spend all this capital, right? The 1.6T networking components and the copper edge orders are actually showing up in the backlog now.
Yeah. In fact, the CEO said, and this is pretty definitive, they expect accelerating demand throughout fiscal year 2027 and beyond.
Oh, wow. That is a heavy promise.
It is. Predicting acceleration beyond a 12-month window in the semiconductor market is brave. But they also made a really smart structural tweak. They finally adopted a normalized tax rate methodology for the year, a flat 17% for non-GAAP metrics.
Okay, so no more of those weird tax geography swings that mess up the earnings estimates, because that was driving everyone crazy previously.
Exactly. It makes the baseline math boring again, which is a huge compliment. So the resulting adjusted EPS target is 61 cents next quarter. It's a very clean setup.
It honestly feels like the broader narrative is finally crystallizing. They're cutting the legacy cellular baggage loose, securing the laser tech for the co-packaged optics future, and basically telling the market, capacity is king, and we're building the castle.
That is an accurate framing. The strategy is absolutely there. The risk now is strictly operational. They just have to avoid tripping over their own feet while expanding that gallium nitride capacity 300%.
Right. Just a casual sprint while carrying very expensive fragile things. What could possibly go wrong?
We will find out in 3 months.
We certainly will. All right, that is the story for Semtech this quarter. Thanks for hanging out with us, everyone.
See you next time.
If you want these earnings deep dives to just naturally show up whenever the numbers drop, you can always just follow the show. And as a quick aside, this podcast is actually generated using AI tools, mostly as a project to see if we can take dense financial filings and turn them into a conversational story. We really want to hear what you think, or what ticker we should dig into next, so just drop us a note at earningsunscripted@datamadness.ca. Catch you on the next call.
Take care.